Hey, everybody, it's your boy, Sean McLaughlin at Options Sean on the old Twitter X. Today is, what's today? Wednesday, November 12th, 2025. Hope you're doing well. This is What Are My Options? This is a free for all show. All right. It's going to be driven by questions that you have. This is an opportunity for you to ask questions of me. It's kind of like an open office hours. If you have trades you're considering doing, you need some guidance on an options trade, we can talk about it. If you need lessons on a particular strategy, we can talk about that. I see some people already getting into the chat, which is great. Guys, use the chat. That's how you can communicate with me. Type in questions there. I see Jackson. I see Jay. I see Theo. What's up, guys? Um, so before we get in, I see a bunch of symbols here, a bunch of tickers here. One question that's been presented to me, both in the All Star Options chat room as well as on Twitter. People want to know, people want me to expand a little bit on some hedging strategies because, hey, we're in a challenging market. It's been a little choppy. A lot of the high beta names we're trading are kind of starting and stopping back and forth. It's been kind of a we've been having a lot of rug pulls lately, and so people are getting frustrated and they want to know how can they protect their portfolio when we're not necessarily crashing, but our trades just aren't working, right? And that's a weird situation, right? You think if you got a long portfolio and your trades aren't working, you must think that the market's going down. Well, that's not necessarily the case, especially with options trading, right? With options trading, especially if you're long premium and if the stock's just not going anywhere, you're going to be losing money because the premium is going to come out of those options every day as we march inexorably closer to options expiration. So in the past, when we've talked about hedging, we've talked about directional hedging, talked about, just simply buying puts in the S&P or the NASDAQ or buying out of the money put butterfly spreads. All great strategies, particularly if we get a down move, right? If we get a directional move, that's what we're hedging for. If we get that type of move and we have a put butterfly spread on and out of the money put butterfly spread, or if we have some long puts, those are going to pay very well in a big directional move. But as we've established, we could lose money when the market's just kind of going sideways. And if we do that, those hedges I'm talking about, those put butterflies and those long puts, they're not going to pay, even though our portfolio is losing, but the market's not going down. So those hedges aren't going to pay. So what other kind of hedges? There's all kinds of hedges. All right. The next hedge I want to talk about, and this is something I've been employing a lot lately, is call credit spreads, right? A call vertical spread or a bear call spread. It goes by a lot of names, but a call credit spread is simply a situation where you sell a near the money strike, maybe just slightly out of the money strike. Okay. That's where you're getting most of your premium from, but you protect it by buying a call a little further away to define your risk. That's the key. We want to define our risk. So I'm going to flip my screen here. Gene, if you want to pull up my screen, let's look at SPX. This is the instrument that I like to trade. And we talked about this a little bit last week, but I'll reiterate. I like using SPX for hedging, especially when I'm holding short premium because it's a cash settled product. And what that means is I don't run the risk of having my short puts or my short calls being assigned against me if they're in the money, getting assigned against me early, right? If you have a defined risk trade on and you get assigned a portion, one of those legs gets assigned against you, it's not necessarily an economic hit. You're not going to necessarily lose. I mean, there are some scenarios where you could, but really it's a pain in the ass, right? You get assigned stock that might result in a margin call. Your brokerage is going to call you or hassle you. They might exit your positions on your behalf at prices you wouldn't have wanted to exit. It's just a hassle, and there's added commission costs. So I don't like using instruments like SPY or the QQQ to sell credit spreads in as for hedging vehicles because of that reason. With SPX, it's cash settled, and SPX also has a cousin, XSP. I can't type it. XSP, which is the mini SPX. It's 1/10 of the product or the size. You could trade that as well, but let's just stick with SPX. Let's talk with the big boys. It's cash settled. So if I have a short call that expires $2 in the money on expiration day, all that's going to happen is that my account will be debited $200, right? That's for a one lot. If it's $2 in the money, that's going to equal $200. It just gets comes out of my account at the end of the day. No big deal, right? And then I'm flat. I have no position on. I'm in cash. All is good. Okay. That's why I like trading SPX or XSP for those of you who want to trade smaller. Now let's talk about what a call credit spread looks like. Let's put one together. All right. Let's look at the money strikes here. Let's look at November 1st. Okay. This is the other thing too. I like to do these with just one day to expiration, right? I'm trying to make some money quick, right? If the market's going nowhere, I want to get paid quick. Now remember, with hedges, the goal isn't necessarily to make money. I know this sounds crazy, right? Every trade we put on, we want to make money. But the goal is to make money when the rest of our portfolio is losing. That's the point of a hedge, right? If our hedge loses money, that's probably good news for the rest of our portfolio. Not always, depending on what you have on, right? Depending on the type of names you have on, how correlated they are to the S&P. But if your hedge is losing, likely your portfolio is winning, and likely it's winning at a magnitude that far outstrips whatever you're losing on your hedges. Depends on how aggressive you're being with your hedges, okay? So I'm going to look at selling a 1 day to expiration call credit spread. Okay. So bring my chart back up there, Gene, and let's look at the chain here. I'm looking at the November 13th that expires tomorrow. And look, you could do this any way you want, any size you want. I'm going to keep this pretty small. I'm going to sell the 68.45, which is just one strike out of the money right now. And I'm going to buy the 68.55, which is $10 away. Okay. You can go 20, you can go 30, you can go 50. Right? You can go as far as you want. The further you go, the bigger credit you receive, but also the greater risk you take. Okay. There's no free lunch here. But I'm just going to do a simple $10 wide. Looks like I'll get about a 465, it was called 475 credit. Let me open up my risk profile tab to show you what this looks like. Okay. Let me stretch this out a little bit. So for those of you who are unfamiliar with P&L graphs for an options chart, what you're looking at here are two lines. Along the x-axis is the range of prices for the S&P, the SPX, and along the y-axis is the potential P&L, positive numbers above this middle line 0 and negative numbers down here. And then these two lines you're looking at here, the green or the blue line, the bright blue line, that's what your P&L would be at expiration across a range of prices. So if you put this trade on and SPX closes at 6,800 tomorrow, then you're going to walk away earning $475. How did I earn $475? Because that's the credit that I'm collecting right now to put this spread on. If both of my calls expire away worthless, I'm going to keep that $475. Winner, winner, chicken dinner, right? Now the flip side, if SPX closes at, let's say, 6,900 tomorrow at expiration, then both of my calls are in the money, and that in the money spread is $10 wide. So the most that spread can cost is $10, right? So if I have to basically, if my account will be debited $1,000 at expiration, well, that's $1,000 less what I collected today, which is 475. So I will lose 525 at expiration. Now this purple line just kind of shows how my P&L would trend today as I'm putting this trade on, right? It'll show how, what my P&L will be approximately across these range of prices. Now, here's the great thing about these types of trades. Let me stop this from moving around here. Let's just lock this price and we'll just call it $5 credit. The great thing about these trades is with the S&P where it is right now, let's call it 68.40, 68.45. If the S&P doesn't do anything, right, it just freezes up. It basically trades right here and it closes here tomorrow. The market didn't do anything. It didn't go anywhere, but I'm a winner, right? I didn't need the market to crash. I didn't need the market to even trend down all that aggressively. I just needed to not go up. That's the trade with a hedge, with this type of hedge, right? I'm just betting on sideways to down action. In fact, a trade like this There's five possible outcomes for what the SPX can do between now and tomorrow's expiration, right? SPX can go down a whole lot. The SPX could go down a little bit. The SPX could go absolutely sideways, going nowhere. That's number three. Number four, it could go up a little bit, or number five, it could go way up. All right. Now, here's the thing. In three out of those five scenarios, I'm a sure winner, right? If it goes way down, if it goes a little bit down, if it stays sideways and doesn't do anything, I'm a sure winner in this trade, right? I'm potentially a winner in the fourth scenario if SPX goes up just a little bit. Potential winner, not for sure. Could be a small loser, could be a small winner. The only way I surely lose is if SPX moves up by about 10 bucks from here. Okay. So these trades are great trades, I think, for an options portfolio, where you are particularly long premium. Okay. So if you're somebody who's just buying calls to express your bullish bets, just buying puts to express your bearish bets, okay. If you have a lot of long premium on, these types of trades, for my money, are great trades. Now, they pay you when the market goes sideways, which is what we need. Now, here's the thing. Let's say you put this trade on and you hold it all day today, and then tomorrow the market opens up, the market's way down. Well, that's an easy question or easy solution. You just either let the thing expire worthless. You can do that and hold it for the rest of the day if you want to keep that risk on the books, or you just buy to close it for a nominal price. We're collecting around $5 for it today. Maybe tomorrow, if there's a huge gap down, if we're down, 1% or 2% in the S&P, maybe you buy it back for 50 cents. Maybe you buy it back for 25 cents. That can certainly happen. Okay. So you have a choice. You could either let it expire worthless, holding that risk all day, or just taking the profit and maybe putting on a new trade, doing it again. All right. If the spread is in the money, you have a choice. You could either take the loss and move on, right? That's not a bad choice, right? Cutting losers and just moving on with your life is fine. Or you could do what I do, and I can roll this spread up. I move it up a strike and out another day. It's going to cost me a debit. It might cost me 20 cents. It might cost me 30 cents. It might cost me 50 cents. But it's better than taking the full loss. And then I live for another day for this thing to potentially roll back and make me profit. It's a hedge, right? So let me show you a real world example of this. I'm going to show you my actual trades that I have on right now, and I'm going to adjust my position. Okay. How about that? Let's do this. I'm going to show all, but I'm just going to focus on these ones here because in November and December, I've got some put butterfly spreads that we've talked about. We don't want to worry about those right now. We're going to look at just my November options that are expiring today. All right. So they're in the money. Let's actually go here. Let's open this up. We're going to open this up wide because there's a long way to go down to my first spread because I've been doing this for several days now. So I got one spread here. You can see it here. I'm short the 66.70 and long the 66.80. These are well in the money right now. Okay. That's fine. Let's roll that one first. We're just trying to buy ourselves another day. Again, this might not be the best move for you. All right. This is a move for me because for me, I'm considering this trade a hedge. All right. So with Thinkorswim, it makes it real easy. I can create a rolling order. I'm rolling. It creates this order here. And what I'm doing is I'm basically closing the November 12th call spread and then reopening the next expiration, which is tomorrow, November 13th. Now, when I set this up automatically, it just kind of automatically selects the same strikes. I'm going to move my strikes up just one strike for each one. I'm going to move my short call up one strike and my long call up one strike. And look at that. It might cost me, I mean, these numbers are going to move all over the place. I'm going to put a debit in for 20 cents. Let's see if I can get filled for 20 cents to roll that spread. Boom. I just got filled. Look at that. So quickly. I got filled for 20 cents. It cost me 20 cents to buy myself another day, and I moved the strike up one strike. It's still way in the money, right? It's still way in the money. But now this is truly a hedge, right? If the market rolls over and rolls off pretty hard, I'm going to be very happy I've got this one on. Now I've got two more spreads that are they're closer to the money here that I need to roll these two. These are also in the money. These were both $10 wide spreads. So let's roll both of these. Let's go here. I'm going to start with the 15 and hold on. How do I select that? I guess I have to, Let's see if I can do this right. Vertical roll. Yeah, there we go. So I'm going to roll my 15s, right? That's the 68.15 that I'm short and the 68.25 that I'm long. Okay, that's here, those the November 12s. I'm going to roll these up a strike as well. So I'm going to move these one strike at a time. Sorry if this is tedious, guys. I know this doesn't make for great television, all right? But I'm showing you how this actually works, all right? I'm showing you how I'm doing it. Now this spread looks like the prices are moving around here. Let's put in there's 95 cents. Let's put in a bid at 70 cents. Let's see if we could roll this one for 70 cents. I'm gonna put it out there, let it marinate for a little bit. So that order's working. I'm gonna do the same thing with this other spread that's at 68.20 and 68.30. So let's go here. Create rolling order. So wait, hold on. So 68.20, 68.30. So I'm closing the 68.20, 68.30. I'm going to roll it up a day. I'm going to roll it up a strike. There we go. So I got it all set up. Looks like I'm going to put a bid in for 70 cents on this one as well. So let's just put those out there, let them marinate for a second. And we're seeing already, unlike that other order that didn't get, or that got filled really quick, these two are taking a little time. So what I will end up doing is just, keep increasing my the bid that I'm willing to pay for by 5 cents at a time. Okay. So that's what I'm doing here with both of these spreads. I'm just increasing my bids, see if we can get filled. I'm now working 75 cents. It's telling me the fair market price is somewhere around, these things move around a lot, especially because they're in the money. But the fair market price is somewhere around the 80 to a dollar area. So we'll increase our price again here a little bit. It's all I'm doing here is when I'm rolling these things, I'm just buying myself more time for this thing to play out. Again, these are hedges. I don't necessarily care that they lose, because if they're losing, the rest of my portfolio is probably winning. That's kind of my thought. But I want to live to fight another day on these things. I'm going to keep increasing my prices here until I can finally get the market maker to bite on these. Boom, boom, boom. All right, I'll do one more increase, and then this is boring television. Back to it later. But just letting you know that I'm going to work to roll these spreads. And what's going to end up happening is the final piece, at least this is for me, okay? Maybe not for you, but for me, I like to, for my hedges, I want to be collecting net cash flow on these things every day, for 20 cents, right? Where we go? There we go. I already sold that one spread for 20 cents, or I bought it for 20 cents, okay? These two orders I've got here, they might cut, when all is said and done, it might cost me $1 each to roll these. So that's $2 right there, plus the 20 I already spent. So that's 220 bucks I've paid out. Those are debits. Okay. I want to recoup that. Debit. Well, I will now initiate, I'm initiating new spreads now in tomorrow's expiration. I will initiate a new spread, $10 wide at the money. To recuperate that, it looks like I can get about 510. All right. So I need to recoup about 220 in debits for my rolls that I've just done. Okay. And I'll do that. And then I will add another spread for $5, making me cash flow positive on the day. And ultimately, we'll get a pullback, or the market will just sit still for a little while. It'll happen. And when that does, eventually these spreads will all eventually be out of the money, and I'll close them for nominal debits and calculate my winnings from there, right? Again, this is not, I don't necessarily encourage people to use this as a standalone strategy. All right. This is a strategy that you use against a portfolio of particularly long options premium right now, which is what I am. Okay. I got a lot of long positions. I'm skewed long delta in my portfolio, betting on a market rally, right? And I'm long premium. So the theta drag is, is significant. So doing something like this and being aggressive and being cash flow positive on these spreads every day, for me, is something I do to take the sting out of markets that are not cooperating. This is not a perfect hedge, okay? you're probably gonna hate it when you keep having to roll these into money spreads and pay debits, and your position's getting a little bit larger as you go up. You're probably gonna hate that, but you have to bear that in mind and measure that against the fact that you likely have, or you should have, a large portfolio full of or long positions that are vastly outperforming. Okay. So when you're hedging, hedging does something. The real value of hedging for people is it smooths out equity swings. Okay. So when the market's rallying, your trades are winning, but your hedge is losing. So that's going to damper, or it's going to tamp down the gains a little bit, right? Where you think you might make 10 grand in a day, you might only make five. Okay. Sometimes that'll suck. But then you'll love it on the flip side on a day where you might be down 10 grand, your equity positions are all down 10 grand, but your hedge made 5 grand. All right. So it smooths out the equity swings. For those of you who are having a hard time managing, dealing with portfolio volatility, which is a normal thing to deal with, right? It's a normal thing to feel a little uneasy about, especially if the swings are significant. Hedging strategies like this strategy can help, keep those swings a little bit more manageable, help keep your emotions in check, help keep you um, following the plan, right? Because the last thing we want to do is be put on tilt because our portfolio is going all over the place and then we start making bad decisions. I've been there. You've probably been there. There's no shame in that, but we need to learn from it and try not to repeat those mistakes. All right. I think that's all I got on hedging for now. I think we covered it pretty well. I'm sorry if that was confusing to some of you. I know it wasn't very compelling TV to watch. I'm gonna work those orders later once I get off this call to adjust my position. But believe you me, I will adjust my position. All right. I saw some tickers come up here. I want to address those real quick. Medtronic. Let's see. Will it break through 100? Well, Jay, I don't have a crystal ball. I would like to see it break through 100. The $100 roll is certainly in play. Would that be an all-time high? I believe no, it would not be an all-time high. Medtronic was definitely higher than 100 several years ago. So that does not qualify as a $100 roll. A true $100 roll, if you guys heard me talk about $100 rolls before, um, is when a stock is hitting a big round number, in this case, $100 for the very first time. All right. When a stock is approaching a big round number, like 100, 200, 300, something like that, for the very first time, there's human nature comes into play. It acts like a magnet. I've seen it happen more times than I can count. A stock just is drawn to that number. Traders just, we all just kind of agree it's going to get there. And it usually overshoots. All right. Medtronic does not qualify as a $100 roll because it's been to $100 before. There are still bag holders higher than 100 who'd be happy to sell it at 100 right now. So not saying it can't get there, Jay. I'm just saying that my initial thought was, ooh, $100 roll candidate, but no, that's not the case. You can see I've got an alert on my chart here. I would consider getting involved if it broke above 98, 98.50-ish in that area. Do I know it's going to go through 100? I don't know. Chart's looking good though. Let's see what else. What other tickets we have up there? We had LNG. This is not a play for me. I'm not saying it can't work. I'm not saying it can't work, but you guys know if you've been following me for any length of time, I'm more of a momentum trader. I like to buy things that are already on the move, that are breaking out, fresh breakouts. I'm not a catch the falling knife kind of guy. Not to say that this is a falling knife, but to me, this is a pattern that needs some work. All right. I want to buy it moving from, 245 to 300. I don't want to mess around in this 213 to 240 area, where it could be very choppy and very sloppy. For an options trader, that could be tricky, right? So not for me, Jay. I'm not a big fan of that one. Let's see what FDX. Now this is a chart that's really starting to work. I had a great day yesterday. Volatility is rising here. I don't think it's because there's earnings on deck. Earnings are, I mean, probably at least a month away. Volatility is rising. If you wanted to play something like this, I would consider some kind of call spread. It's a higher price stock too, right? 270. So it's going to have higher absolute price options. Call spread, if you like this, buying maybe like the 280 calls and selling the 300s could be a good trade. Well, actually, let's see here. The 308 is the high, at least the 52-week high. So likely to hit a pause in this 300 to 310 area. So let's look at what a price of that would look like right now. Let's say if we did, let's give ourselves some time. Let's give ourselves at least 3 months. Let's say March options here. If we were to buy a 270, buy the 270 and sell the 300s, okay, where we think that they might run into some upside resistance, you could buy that spread for about 11.95 now, which I like that. I actually no, I'd rather be a little cheaper. I'd rather be a little cheaper. Generally speaking, this is not always true, guys, but generally speaking, when I buy a call vertical, which is what this is, a bull call spread, I generally don't like to spend more than a third of the width of the strikes. So the width of these strikes, I'm long the 270, short to 300. That's $30 wide. So generally, I don't want to spend more than 10 bucks. I might spend 10.50, I might spend 10.75, but generally, right around that 1/3 levels is most I want to spend. This is right now quoted at around 11.80. Probably cost me 11.80 to get in. I don't like that price, but we could shift the strikes here. We could just be, go a little further away, do the 280, 300, or let's do the 310 because we saw the upside resistance was right around 308. This is more my speed. Look at that, just under 10 bucks. Okay, a $30 wide spread for 10 bucks. Let's analyze this. This is what this potential trade could look like. The P&L graph, right? We are currently right here, and we could potentially make as much as 2,000 bucks on this trade, or we could lose almost 1,000 bucks. So 2-to-1, which is that's a good risk reward, reward to risk for a long call vertical spread. And I like having that short strike being around 310 because let's bring that chart back up. That's the 52-week high. Well, close to it, right? 308 is a 52-week high. It would not surprise me at all if FedEx continued this breakout. It would not surprise me at all if it at least paused in this area, right? And that pause might take longer than we like. And when we have options that have expiration dates, we don't like pauses, right? Because every day that pauses can cost us money. So I like buying a 280, 310 call spread in FedEx if you think this thing's going higher. That's a trade to consider. Theo asks, what are my thoughts on long call butterflies? So we talked about long put butterflies a little bit earlier. He says, with the sideways to slightly bullish tilt on strong tickers, does it take out the premium and isolate it? Does it isolate it, your thesis? Call butterfly spreads, they can work for the same reason put butterfly spreads can work, right? If you think that the market's going to have a slow drift up to an area, to a target that you have in mind, go for it. It can be a great trade. I don't do a whole lot of call butterfly spreads. In fact, I don't think I can remember the last time I've done one. Now that I think about it, I've done put butterfly spreads as I've pointed out. I've done them in the SPX. So don't do a whole lot of the call butterfly spreads. But like I said, if you've got an area in mind that you like, why not? I guess part of it too is it's a four-legged spread. That's just those are commission costs that add up. I'm mindful of my commission costs. Doesn't make them a bad trade. It's just not something I do a whole lot of. Theo, I think it looks like you're expanding on your question there. Could I do a butterfly instead for a sideways do nothing market if you prefer debit trading? Look, if you're convinced that we're going nowhere, right? And you want to do a butterfly that, kind of peaks right at current prices, you can do that. Nothing wrong with that at all. In fact, that can be a great trade if your thesis is that we stay put. All right. That's the key. The thesis has to be that we're staying put. I'm doing the call credit spreads because I want to be protected if we sit still or if we go down, right? A call butterfly spread or a put butterfly spread that's at the money. If it goes too far down, it's not going to pay. It's going to be outside of the guts of that spread. So I like doing the call spreads so that I can make money on any down move, right? Of any length or distance instead of the call. Instead of butterfly spreads. Let's see. DFEN. Let me pull up that ticker real quick. Someone asked about DFEN. It's a daily. It's one of those 3X. Was this defense stocks? This is probably defense stock. I mean, I don't trade these 3X leverage products, to be honest. I certainly wouldn't, I certainly see no need to trade options in these things, right? Because they're already leveraged, right? If you're doing options on a 3x levered product, you're just adding leverage upon leverage upon leverage. Now, look, on those types of trades, if you get them right, they can be home runs, but you're probably paying for a lot of drag in these things. All else being equal, they probably have some significant drag. I don't have any take. And looking at this chart right now, I can tell there's not a whole lot of volume here. This thing is traded 58,000 shares of stock today, which tells me that the options are even more illiquid. I mean, look at this options chain here. Volume, see all these NAs? There's a lot of NAs, meaning nothing is traded in these options chain. Look at the bid ask spreads here. In the November options that expire in 9 days, the at the money call is bid $2, offered three. That's a huge spread. And if you go to December, it's even worse. Look at that, 360 bid, 620 offered. These are a no go for me, buddy. Can't trade these. There's not enough liquidity if I wanted to trade them. Dan, I see you, buddy. Hey there. Hope you're doing well. Okay, last tickers here. We got to wrap it up here. I know there's another show coming up on the network pretty soon. So let's talk about Jackson had a few tickers in here. CACI. Love this setup. This looks like a trade that stock is ready to go. It's a higher price stock that gives me pause. Probably definitely gonna have to trade this with a spread of some kind. Let's shorten up this option chain a little bit. Or I mean, if you wanted to go far out of the money, like the 25-ish Delta options in December, I mean, you're gonna have to look at the 630 strike to buy this. This one also, by the way, I'm also noticing doesn't have a lot of volume. So actually, this one may be a no play just because of the volume. Speaking from an options trading perspective, not a stock trader. Stock trader, go ahead, buy this thing, right? But there's only been 62,000 shares traded today of the stock. And again, if you look at the volume columns here for the calls and the puts, NAs across the board, right? There's just nothing trading here. So no going on CACI. What else? AZN you liked? Whoo, that had a nice little breakout. It might be a little bit of a chase right here. It looks like that's an earnings pop, which is good. So options premiums are coming out a little bit. Feels like a chase for me right now. But with options premiums coming down, you could play it with long calls. Let's see here. The 25 Delta call in January is the 95 strike. You could buy for $1.30. That's not bad, actually. It's not bad. The January 95s, which is only $7 from here. I mean, the thing just moved $7 in 4 days, right? 5 days. So another $7 by January. Not a bad trade. Not a bad idea. Um, I could get involved in this AZN. I feel like I could maybe just be a little patient and wait for a better entry, but gun to my head, if I had to get into this trade right now, I'd probably buy these January 95s. There we go. Let's go. Schwab. It's always cool looking at Schwab ticker when I'm using the Schwab platform, right? I'm using Thinkorswim here. Schwab's looking like it's breaking out, man. This looks good. Earnings are out of the way. We had earnings about a month ago. This looks like a fresh breakout is on deck soon. I mean, we probably need to clear that 95 or 99 hurdle, but we're getting there. We're getting there. Let's see here. I mean, you can see I'm already positioned here. I got some December 97 and a half calls. I'm, nothing big, but just a one lot. But I'm in it. But if I want to do longer term, let's look in March here. 25 Delta calls. If we wanted to keep it simple, you could buy the 110 calls in March, pay about 210 for them. Not bad, not bad. Um, would this be $100 roll? Let's see if we can zoom out a little bit. That might be $100 roll there. I could see better on my other chart. Let me pull up my other chart real quick. Boom, boom. Schwab. It's really easy for me to do monthly charts here. Yeah, that would be a fresh all-time high at 100. So $100 roll candidate here for sure. Makes me like this trade even more. $100 roll is in the cards, almost a foregone conclusion as far as I'm concerned. So I like Schwab. I like it. Get involved. Let's see. Last ticker here, and then we'll wrap it up. Someone mentioned Oracle. Let's look at Oracle real quick. Oh, we're looking at a weekly chart. Let me bring it back to a daily chart. Whew, boy. What's my thought on Oracle? My thought is it's a no play. It's a no play. It was looking real good early this summer, or sorry, late this summer, early fall. That gap was monster, but it hasn't held. It hasn't held it. In fact, it's come back and filled this gap and more. I think this is a stock you just need to let it set up. I mean, I don't know, I'm not even sure I'd want to put a bearish bet on it at this point. I think the bearish trade would have been when it broke the 50 period moving average here, like on this day. What was that? The October 30th? I mean, of course, hindsight 2020, right? But I mean, if anything, I would have put a short trade on right here, and I'd be holding that thing now. If I was short right now, I would be holding. I wouldn't add to. I wouldn't get short here now. I'm not. I don't want to get short. But if I were already short, like if I got short back there at the end of October, I would hold this. I would hold it. Don't like it long right now. It needs to set up. I see that it's coming up on a rising 200-day moving average, and that can offer some support, but the thing's got to prove itself first, right? I like to let the stock make the first move generally, not always, but generally. I like the stock to declare itself, and then I'll get involved. Sometimes that makes me late, but you know what? If you catch a rocket ship, a stock that's going to go on and double and triple, you can be a little late. It's okay. There's plenty of meat on that bone. All right, guys. I didn't get to every question, I don't think. Theo, I see you had a follow up there on the butterflies. You're trading them with Robinhood, zero commissions. Yeah, look, I have no beef with Robinhood and zero commission trading, right? If you are especially if you're just a single leg option trader, you're just buying straight calls or buying straight puts, Robinhood could be a great platform for you. Okay. Just know that there's no free lunch. All right. For those of you who need to hear this, I know many of you know this, but for some of you, you might need to hear this. An options platform, I'm not picking on Robinhood, there's others out there, but options platforms that offer you free commissions, there's no free lunch. You're not getting as good of fills as somebody like me who is paying a commission. Now, those better fills might be negligible, but sometimes they're not, right? Sometimes I'm getting filled at much better prices than you are, or sometimes I'm getting filled on a position that you don't get a fill on because the broker couldn't fill it at a price that's advantageous to them. All right. Robinhood is selling your order flow to Citadel and other places. And they're only going to take your order if it's advantageous to them, which means disadvantageous to you, right? So, yeah, you might be saving 50 cents on not paying an option contract commission, but you might be losing $1 on the fill. All right? Those things add up. So I'm not pissing on Robinhood. Robinhood's a great platform. I have an account with Robinhood for my son. We trade stocks on it. It's more for long-term holdings. But if you're doing single leg trades on Robinhood or a similar platform, it's okay. Just know it's not free. It feels free, but it's not free. All right. But if you're doing multi-legged spreads, like a four-legged butterfly spread, I don't know. I have no experience trading those on those platforms. I imagine they might be tricky, and I imagine it'd be a hard time getting fills. But that's just maybe the boomer in me. I'm not a boomer, but I sound like a boomer sometimes when I talk about these newfangled tools. They're just not as good as the old stuff. I appreciate how I sound. All right, folks, I'm going to wrap it up there. This has been What Are My Options? Thanks for the questions. Thanks for the tickers. I hope my discussion on hedging was helpful. Just one more option for hedging. There's lots of ways to hedge. There's no perfect way to hedge. And hedging is a double-edged sword, right? It helps you when you need it, but it hurts you when you don't. Right? Smooths out the equity swings, which is what hedging is supposed to do. And that's what I'm trying to do with my hedging. All right, folks, have a great rest of your day. I'll be live tomorrow at 3 Eastern with the live options jam session where we review portfolio action in the All-Star Options portfolio. Positions we've exited, some for wins, some for losses, positions we may have made an adjustment to or taken some profits or taken some risk off the table. We'll update stops on existing positions. We'll probably have a lesson or two, and we'll review new trades we've put on since in the past week. So see you tomorrow at 3 Eastern. Otherwise, have a great rest of your trading day, and I'll catch you next time. Bye-bye.